All right, we might make a start now. My name's Robert Warnock. I'm a principal lawyer here at Harwood Andrews. I'm joined by Jamie McCallum, Senior Associate, and Maddie Lupino, Associate. As you can see on your screen, the seminar today is Trust, Property and Taxes, What You Need to Know. We're looking at some very latest developments in the trust and property area. I'm going to start off by looking at some developments in the trust here, mainly the Section 99B developments that's occurred and what we need to know. Following me will be Jamie McCallum, and followed by him by Maddie Lupino. Before we get underway, just a couple of things to note. If you have a question, please use the Q&A button and put in your question. We'll endeavour to leave some time at the end to answer questions, depending how we go. We won't be answering questions during the presentation because we have quite a lot of material to get through. If you have any other issues, such as any technical issues, you can put that in the chat box. Use the chat box and we'll endeavour to try and help you in relation to the issue you might be having. Okay, well, let's get underway because there's quite a lot of material, as I said, to get through. So I'm looking at this first part of the webinar is on Section 99B and what's the fuss all about. Imagine that you have a client who receives $50,000 as a gift from a wealthy non-resident grandparent who says they've got some spare cash and they'd like to help their grandchild out. Now, this client may or may not tell you about the amount. Even if they do tell you about the amount, they say it's a gift, so no other thought about it. Obviously, it doesn't go in the tax return, and nothing happens. Then some months later, this client receives a letter from the tax office asking them for information about what this amount, this $50,000 that was deposited into their bank account, what's that about and where did it come from? And this is a real life type example because, as we know, under the Cash Transaction Reporting Act, that amounts received over $10,000 get reported to AUSTRAC, and AUSTRAC then has communications with the tax office. So this could easily happen. That client inquires about from their grandparent about the money. Says, "Look, I've received this request for information," and asks the grandparent about the money. And as it turns out, the grandparent says, "Well, actually, where it's come from is that for many years I've had a trust and I've been accumulating income in this trust for all these years, and I've now got quite a lot of income, and I'm helping all the grandchildren out, and so I'm giving them all some of the cash, and it's actually a distribution from this trust." That information is passed on to the tax office, and next thing you know, your client has received an assessment for that amount, plus penalties and interest. This is what Section 99B could be about. When it was introduced, Section 99B, in the explanatory memorandum said it was introduced to capture, as you can see on the slide in front of you, that it was introduced to capture an amount paid to an Australian beneficiary out of income from foreign sources that has been accumulated in a non-resident trust estate and would not have been taxed while the income accumulated. For example, you have a non-resident trust, earns interest income, it's just accumulated, it's not distributed anywhere, it's accumulated in the trust, so therefore each year as it's being accumulated, it forms part of the corpus, and then some years later, that amount, distribution out of corpus is made to a resident beneficiary. That's what this Section 99B was introduced to catch. However, that's what the explanatory memorandum said, but that doesn't necessarily mean that's what the legislation says, because there's nothing in the legislation that's limited to non-resident trusts. So let's see what the legislation actually says. In Section 99B, subsection 1, the actual wording, and then we'll break it down, actually says where at any time during a year of income, so it's any time during the year of income, an amount being property of a trust estate is paid to or applied for the benefit of a beneficiary of the trust estate who was a resident at any time during the year of income, the assessable income of the beneficiary of the year of income shall, subject to subsection 2, include that amount. So as you can see in those boxes on the screen, what we're looking at, we need a trust estate. So we are talking about a trust, and an amount being property of that trust estate, and where that amount is paid to or applied for the benefit of a beneficiary of the trust estate, then it must be included in their income. That is very, very broad. And as you can see from that wording, it does not limit it to non-resident trust estates at this point. Also, Section 99C expands the meaning of applied to, paid or applied to for the benefit of somebody. And that expanded meaning can include where the trust estate not only distributes income or distributes an amount, including out of corpus, to the beneficiary, but includes the amount lent, if the trust lends money to a beneficiary, or if a beneficiary uses an asset of the trust, then that can also apply and be caught as seen as a payment or apply for the benefit of that beneficiary. Notably, the beneficiary of the trust estate, it talks about the beneficiary being a resident at any time during the income year in which the payment is made. So let's have a look at this example. Here we have John, who's a non-resident, for the period 1 July 18 to 30 June 22. He lives in New Zealand, lives and resides in New Zealand, has a trust in New Zealand Trust, which derives $20,000 of interest income. And it's accumulated by which the trustee accumulates that income. Then, as you'll see, move across to the right there, you'll see that John, or the trustee of the trust, I should say, makes a corpus distribution on the 2nd of July 2022 of that $20,000. So it distributes from corpus because that interest income was accumulated in prior income years, and therefore at the end of the year it's accumulated, then becomes part of corpus in the next year. And it distributes that income or that amount to John out of corpus. Later on in that same financial year, John becomes a resident, in this example, on 1 February 2023. So therefore 99B applies because this is an amount distributed from the trust, which has been distributed to John at a time he was a resident in the same income year in which the distribution was made. So the application of 99B. So you can see it is quite broad and far-reaching. There's an exception. So 99B1 said these amounts are assessable except to the extent of the application of subsection 2. Now, I'm not going to read the whole of what subsection 2 says, but just note the first couple of paragraphs and how this applies. Notice the subsection B, subsection 2 says the amount that would be assessable in the income of the beneficiary, it is reduced. The amount that is assessable is the amount that would be that is distributed that would be reduced by the amount that the beneficiary shall be reduced by so much of the amount as represents. So this amount, the assessable amount, gets reduced by the amount as represents A, corpus of the trust estate. So if it's distribution out of corpus, that reduces the amount that is assessable under 99B1, except to the extent to which it is attributable to amounts derived by the trust estate that if they had been derived by a taxpayer being a resident would have been included in the assessable income of that taxpayer. So if the amount would have been assessable had it been derived by the taxpayer directly, a resident taxpayer directly, then it does not form part of the exception and therefore would be assessable. And paragraph B, also accepted, is an amount as represents. So an amount that if it had been derived by a taxpayer being a resident would not have been included in assessable income. So if the amount is received by the beneficiary, 99B1 initially applies, but if that amount that the beneficiary received would not have been accessible in the hands, if the beneficiary had received it directly, then in that case, it would also not be accessible under 99B subsection 1. So that means we need to consider a hypothetical taxpayer. That is, someone, if the amounts would the amount have been accessible by the taxpayer had they been a resident, or if they were a resident of Australia, then the amount will be caught under 99B1. A distribution received under 99B1 that would not have otherwise been accessible to the taxpayer if they had received it directly as a resident would therefore not also be accessible under 99B1. So we need to look at this hypothetical taxpayer. The example we have here on the screen is we've got a foreign trust, the Campbell Foreign Trust. It had $100,000 originally settled on it and $100,000 of accumulated income over the years. It now distributes out of corpus that $200,000 to a resident beneficiary. So what are the implications? Because initially 99B1 says the entire $200,000 is accessible. So we look at the first exception under subsection 2, paragraph A, and the corpus amount, $100,000, if that had been derived directly by the taxpayer in Australia, would not have been accessible here in Australia and therefore is not accessible under 99B1. So that comes within that corpus exception. The second $100,000, which in fact represents interest income, because had a resident taxpayer derived that would have been assessed on it, it would be accessible to that resident taxpayer, then that does not get excluded, even though it is a distribution from out of corpus from the trust, the foreign trust, and would be accessible to the beneficiary under 99B1. Okay, so that set us up as to how 99B applies. Now we've just received some recent guidance from the ATO, a tax determination 24D2, and also a PCG, a practical compliance guideline 2024/D1. So 2 draft documents. A consultation is open till the end of August for these documents if anybody wishes to make comments and pass them on to the tax office. So let's look at what this new guidance tells us. The tax determination, the draft tax determination, provides guidance on this hypothetical resident taxpayer. Remember, that is the taxpayer when trying to work out whether those exceptions apply. We have to determine, had the amount been received by a resident taxpayer, would it have been accessible? So what is this hypothetical resident taxpayer? And in the tax determination, the tax office provides that the only characteristic that you can provide to this taxpayer is that they are an Australian resident. Nothing else. No other characteristics. So that means you cannot assume that this taxpayer is either an individual or a trust or a company. So if you cannot assume it is any of those, then that taxpayer is not entitled to the CGT discount. So if that trust, that foreign resident trust, made a capital gain of $1 million, then that is the amount that would be accessible to the beneficiary if 99B1 applies. However, you cannot assume that if the beneficiary was an individual, then it would be entitled to the discount, and therefore the assessable amount is only $500,000. That does not apply. The only characteristic you can assume is that they are an Australian resident, and therefore, again, they would miss out on applying the CGT discount. Also, you cannot assume, if this amount was derived, that if it had been derived by the beneficiary, that they would be entitled to the small business CGT concessions. And therefore, it does not get reduced by those either. And if you take this even further, if we have an Australian resident trust derives in an amount, a capital gain, to which the small business CGT concessions can apply, then if 99B applies to Australian trusts, not just to non-resident trusts, then any distribution from that trust to a beneficiary could be caught by 99B. I'll make some comments about does it apply to Australian trusts shortly. So the other characteristics that we need to look at is what are the characteristics attaching to the amount. And you can look at that. So the amount, if the asset was acquired pre-CGT by the foreign trust, then as the disposal of an asset, a pre-CGT asset, does not give rise to a capital gain here in Australia, it would also not give rise to capital gain if it's assessable under 99B1. So if the amount distributed from the foreign trust is an amount from the sale of an asset that had been acquired pre-CGT, it would not be assessable under 99B1. You also look at the cost base. What would have been the cost base of that asset in the hands if they had been derived by an Australian taxpayer? So you get the benefit of any acquisition costs and cost base. But note, there is an example in the guidance provided by the ATO and in the TD, and that is you need to trace through if the non-resident trust derived foreign income, say interest income, that interest income is then used to acquire the asset. That asset is then some years sold later for a loss, is the example. Then even though it's a capital loss, which would not be assessed in Australia, the tax determination says you need to trace through to where the original funds had come from the accumulation of interest, and therefore 99B1 would apply. So you can see it gets quite complex. The other piece of guidance is the Practical Compliance Guideline 2024/D1, which sets out the ATO's compliance approach. It lists a number of common scenarios where the 99B1 might apply, and it also says what evidence you need to substantiate if an exception will apply. For example, if you have a distribution from a deceased estate where 99B1 could apply to, which that you can, then you need to provide a copy of the will. If it's from the trust, you need to provide documents such as the trustee resolutions, financial statements, etc. So a list of documents of what you need, because at the end of the day, the onus is on the taxpayer to prove that the amount is not caught under 99B1, that has been distributed from corpus. It is not out of an amount that otherwise would be assessed to that hypothetical Australian resident taxpayer. The PCG also sets out a list of low-risk arrangements where the ATO says it will not apply compliance situations, won't go looking for applying 99B in what they call low-risk arrangements. One of those relates to a non-resident deceased estate where the deceased was a non-resident when they died. The trust property was distributed within 2 years. The value of the trust property received did not exceed $2 million. And there's an evidentiary requirement, that is a significant amount of, you better need to provide evidence of all of the above apply. Therefore, you've got to prove what date that the deceased died, that the property, what the property in the trust was, etc. This low-risk arrangement does not apply to testamentary trusts. The other low-risk arrangement is where you've got the provision of trust property in commercial terms. Remember, the 99B can apply for where property has been distributed or applied on behalf of the trust, such as a loan or the use of property that the trust owns, provided they are on commercial terms, market interest rate, market rent, etc. Then the Commission says that is a low-risk arrangement. The final thing to mention in relation to this is that it's not non-relation 99B is the Minerva Financial Group decision. This was a decision where we were concerned that because where a commissioner was fighting the case, or indicating that where a trust made a discretionary distribution of income on a basis that ended up having a lower amount of tax payable in the case, that Part 4A could apply. So we were very concerned. Now, in that case, the full federal court found in favour of the taxpayer. However, in the decision impact statement, which I've quoted on the screen, it is stated by the tax office that the decision does not disturb the Commissioner's long-held view that schemes which included trustees exercise discretion to distribute income can attract the operation of Part 4A. So we need to watch out more in this space. I will now hand over to Jamie to bring us through to the next session. Thank you.
There you go. Good afternoon, and thank you, Rob. So we're past 1 July 2024, and obviously we're now in the commencement of the commercial industrial property tax regime. And my first set of slides is really providing kind of the statutory overview, and then Maddie will provide a bit more of the rubber hits the road practical consequences and what to deal with. So we'll start off. Yes, there's been some fundamental changes to stamp duty for commercial industrial property. And, you know, with governments, we find that change doesn't happen, but occasionally there is a substantial change. And that's why I used my little meme picture there of woe, because it was probably a big deal for having tax reform on duty. So essentially from 1 July 2024, there's going to be a phase out of duty on transfer of commercial industrial property. And after the end of the transition period, there will be a 1% tax, annualized 1% land tax on the unimproved land value. And that's going to be in addition to land tax. And I think that's a real key take home, is that once the CIPT kicks in, it is in addition to land tax, which is a little bit disappointing, because when I initially heard about this regime, I thought that was going to substitute land tax, but unfortunately it is in addition. And obviously, this regime is the Commercial Industrial Property Tax Reform Act 2024. And for the purposes of this presentation, I'll be referring it to as the CIPT. But in essence, it has varied a whole suite of Victorian statutes to ultimately implement this regime. So it applies ultimately to commercial and industrial land. And critically, it's based on the Australian Valuation Property Classification Codes, which is a bit of a mouthful. But these are the codes that are used by valuers and councils to describe particular types of land, whether it be industrial, commercial, or residential. But there's a whole stream of subtypes, and it becomes very detailed. And as you can see, it's these codes that are quite critical, because they indicate what is a qualifying use, okay, that will fall into this new regime. Obviously, there has to be exclusions because it applies to commercial industrial. So you've got residential, primary production, community services, sport, heritage, and cultural properties don't apply. So really the key factor is looking at these codes. So the trigger point really then becomes to, it's firstly that it is captured by the qualifying use, and then the trigger point is any agreement or arrangement entered into or exchanged after 1 July 2024, and then settling after 1 July 2024. So here's a little simple diagram that I hope provides some context. So imagine a scenario where qualifying commercial property is purchased on 2 July 2024, and the property settles on December 2024, and the final duty is paid. And that's really key. We need to anchor this concept as once you're qualifying use, and it qualifies in terms of timing, that first purchaser, if we want to anchor it like that, will pay the last stamp duty. And then the clock starts for 10 years. And then after that 10 years, that's when the commercial industrial property tax actually kicks in as an annualized tax, very much akin to how land tax is dealt with from administrative purposes. So as you can see here in this example, on 20 December 2034, the CIPT anniversary is reached, and then the following year is the new calendar year for tax purposes, and that's when the actual annualized bill commences. So being a little bit cheeky, someone in our office thought I inserted a picture of Taylor Swift. No, it's Europe, the Final Countdown, but I thought that little meme sort of gets us in the mood. It really is. It's all about the timing. And that has implications as well, particularly about if there's a change of use, which we will discuss a little bit further. So as previously mentioned, the first purchaser or the first person to engage in these qualifying transactions is essentially paying the last element of stamp duty, pardon me. The government has also provided an option that instead of paying that final element of duty, that the purchaser or the applicant can apply for a loan. But as you will see here, I'll discuss a little bit more in further detail, there's going to be a lot of caveats on that. But before I get to that, really interesting concept, and initially I had to get my head around this, was that if once the first purchaser has paid this, what we'll call this final stamp duty, and let's say that within that 10 years, they decide to then on-sell, and we'll call it the second purchaser, okay? That second purchaser gets the benefit of the remaining time on the 10-year clock and doesn't have to pay further stamp duty. So what is potentially envisaged here, and it might be for policy reasons to obviously encourage more commercial transactions, is that there's almost like this windfall, or there's this benefit for the secondary purchaser, the person who's acquiring the commercial or industrial property after it's entered the CIPT regime and after the stamp duty. They can potentially get a windfall because they're not paying stamp duty, and they may have 7 or 8 years before that annualized CIPT kicks in. So if we look at this and about this commercial industrial property tax loan option from the government, you'll see that there's a lot of requirements, and it's not open slather. The maximum is price is $30 million, and at the moment, I was speaking to a member of our state taxation team. It's not entirely clear whether that's 30 million inclusive of GST for a purchase price or excluding, but apparently the government will provide more clarity. Further, there is the actual loan from the government is based of 2 elements. One, which is based on the Treasury Corporation Victoria's bond yield rates, and also an additional element which is set by the Treasurer each financial year. And I've plugged in those rates, but for obvious reasons, you can understand that the bond market, there might be some volatility. I'm not a bond trader, but I understand, that they can vary over time depending on the economic performance of the government. And secondly, this secondary margin set by the Treasurer, again, it's not clear how much variance there could be. So the effective rate on this loan, if you were to use that to pay that duty, could be significant. And obviously, tying in with this 10-year countdown is that it needs to be paid in full no later than 10 years. And the expectation is that there's annualized payments as well. How this loan will be then secured is a bit like a charge over the property title, a bit like if some of us may have seen it, some not, but when there's unpaid land tax, that can be secured by a charge. So that's how it will be given effect. And it can't be transferred. It's to another purchaser. It is personal to that particular landowner. Interestingly, the loan must be repaid in full if there's default events for obvious reasons, but also where there's a change in use of the property. So, for example, if it was a commercial qualifying use property and then the landowner converts it, let's say, to residential for development purposes, which we'll discuss a little bit more in detail, that sort of element would then trigger repayment of the loan. However, it is envisaged that, for example, if there was a subdivision of like an industrial warehouse to create further baby industrial units or warehouses, that because that's only subdividing the land but not changing that inherent character, that would not trigger the repayment. However, there's a lot to digest with the requirements for these loans from the government and the applicability of them, and whether or not you meet those requirements. So I would recommend, there's a fantastic fact sheet from the Victorian Department of Treasury and Finance, which is available online if you want to dig a little bit deeper. There's also certain exclusions. Obviously, it's not going to apply to a subsequent purchaser. It really is for the first purchaser when paying that final element of stamp duty. Foreign purchasers are excluded and self-managed super funds. And obviously, where there's non-standard duty transactions like landholder duty, change of beneficial ownership, they're also precluded from this loan arrangement. But it will be very interesting to see generally how much uptake there is of this potential loan regime. Okay. There's other elements that we need to consider here, particularly about what happens to the land use changes. What also is what happens when there's a mixed use as well. That might be, the old typical example, it's one property, one title, but it's the old downstairs shop, upstairs residential premises. And what about agreements that aren't contracts, but that were entered into prior to 1 July? and also exempt transactions. Where do they fit into this scheme? Exempt duty transactions, pardon me, and also potential issues that we need to look at. Okay, so there is an administrative requirement that if there is a change in the use of the land, that there is a notification requirement that you need to disclose to the SRO within 30 days. Now, again, there hasn't been much guidance provided, but it's the common assumption after speaking to our state taxations team is that it's going to be more of a conservative. So, for example, let's imagine a situation where there's a commercial property and the landowner then has got the benefit of the CIPT regime. And this is more of an issue for the second buyer, not the first buyer. But imagine the second buyer has gone, you beauty, I've acquired this property. I didn't pay any stamp duty. This is great. I've got the benefit of the balance of the 10 years, but I'm now going to convert this commercial property to residential. Okay. Now there's a notification requirement for that to notify the SRO within 30 days. And it seems to be the assumption is going to be that it's early on in the piece. So more likely when the commercial use stops, and that could be very early on at the planning permit stage, or like when the actual, there might have been a commercial tenant vacates. So to assume that change and the notification requirement is punted to later on when you might get the actual permit or the certificate of occupancy is probably fraught with danger. And so that's where, again, we suggest that anyone who is acquiring land that is clearly within the CIPT regime and maybe looking to develop, you need to get legal advice. Conversely, it also goes the other way because the SRO are just trying to keep track of what land is commercial, what is industrial. So if a landowner bought residential property and hypothetically converted it to commercial, there is also that requirement to provide the notice to the SRO. Critically, in that example, though, it doesn't trigger the CIPT regime. It's just more of an administrative notice. Okay. This is a little example that I'm posing as a diagram, but I don't want to go into too much detail because Maddie's actually going into a lot more detail in her example. But as you can see, I'm trying to set out a situation where the property has been purchased and there's a change, okay? And there's a notification requirement. In this example, because it's more like the first buyer, there's probably less of an issue, still notification requirement, but Maddie will look at more about that an example in practice. So I probably will rework this a little bit on the fly, but imagine you are the second purchaser and your transaction was exempt, and then you've decided to rezone to residential and you've provided new notice. How does that play out in effect? Well, under this new regime, the SRO will go, thank you very much for providing the notice. Because you got the exemption to stamp duty because you were the second purchaser within that, under the CIPT regime, you've now done something. So we're going to say that you need to pay stamp duty at the market rate when you acquire that property. However, we'll give you a 10% discount on stamp duty as of 31 December for each year that it was, we'll call commercial industrial property, prior to you converting the actual use of that property to, say, residential use. And again, it can go up to a maximum of 100%. And that's kind of a bit like the policy makers throwing a little bit of a bone there, that what we're trying to have here from a policy perspective is we don't want developers just going crazy and buying commercial industrial property during this 10-year kind of honeymoon period, then redeveloping and not paying stamp duty, because that would defeat the purpose. We're trying to get more commercial industrial transactions on occurring, and also development of that type of land. So that's kind of the kind of the barrier mechanism. But at the same time, with the progression of time, at some point there's less of an issue that, after 10 years you converted it to residential. Fair enough. You don't have to be whacked with retrospective stamp duty. Then comes the next issue about, well, what happens if it's a mixed use? Again, typical example that you might find where it might even be one title, where downstairs is a commercial shop, upstairs is a residential. And this has got two issues, potentially at the acquisition stage and potentially ongoing use as well. But the crux of it is we're still to get guidance, but again, speaking to our state taxation team and considering it, the SRO is probably going to look at elements such as the relative floor space of the commercial part of the premises versus the residential, the potential yields as well. So if it's vacant, however, if it's not vacant and being utilised, well, again, it might be looking at the actual commercial returns from those respective spaces. However, again, because at this stage the SRO has not provided specific clarity, it's a little bit anyone's guess because this is the brave new world. So again, I would caution that ultimately, even for a first buyer who's going to come into the CIPT regime, just to understand your obligations moving forward, but obviously in turn further down the track for subsequent purchases, once the CIPT regime is more mature, I would always advise that purchasers really do seek independent legal advice, particularly where that property has a mixed-use element. Just keeping track of time here, I'll try to push ahead, but where does that lead sort of option agreements or heads of agreement where you don't have a formal contract because it's still down the track, but the option or heads of agreement was signed before 1 July? Because of the language employed under the CIPT Act, it does talk about existing agreements or arrangements. So, for example, if you had an option agreement that was signed in 1 March 2024, but the contractor has not been exercised, it's just floating in the ether, that arrangement will not form part of the CIPT regime, even though the contract it was signed potentially after 1 July 2024. Similarly, heads of agreement will be caught. However, again, I caution always seek independent legal advice because these type of arrangements will probably be scrutinised by the SRO for obvious timing reasons. And I suspect that they will put a lot of scrutiny on the contractual and binding nature of those arrangements. Obviously, the one thing the CIPT is just not caught, even if it is a qualifying use, is if the transaction is just duty exempt. So charitable acquisitions or change of trustees or transfer to beneficiaries, where they're exempt, that's not going to trigger the CIPT, even if the land has a qualifying use. Similarly, dutiable lease interests, economic entitlements, corporate restructures are not caught by the CIPT regime. Potential issues. Okay, this is just highlighting, and I don't want to bang on about in too much detail about this, but to suffice to say that if you do have a lot of different structures holding lots of different commercial and industrial land, you do need to be careful because transfers of interests in commercial property where they're significant, 50% over, can trigger the CIPT regime, or there's even the potential for actual land aggregation between various entities that could also be captured by the CIPT regime. Now, there's a lot of sub-rules, so I won't go into that, but again, suffice to say, please, if you feel that you're in that boat, please seek independent legal advice. There's also an interesting callback as well, where if there's a restructuring, for example, tenants in common, where there might have been a 50% transfer of tenants in common share that brings the land in the CIPT regime, and then there's a subsequent 50% transfer after that. If that occurs within the first 3 years, then it actually may be dutiable. So again, need to be careful. Also, another thing for if you're thinking of buying commercial industrial property as a landlord is that once the CIPT is implemented as an annualised tax, it cannot be recovered from tenants under the Residential Tenancies Act and Retail Leases Act. So that again raises some real questions moving forward, whether that will encourage more gross leasing, particularly in the retail leases space, if that's another outgoing that landlords can't capture. In the meantime, thank you very much for your time, and I'd now like to hand you over to Maddie Lupino. Thank you.
Thanks, Jamie, and good afternoon, everyone. So as Jamie mentioned, I'm going to run through some of the practical examples of the CIPT in practice, what we're already seeing regarding the CIPT in the industry, and some examples of what we might see in the future as well. So as the transition period for the new regime is 10 years, we most likely won't see the main effects for another 10 to 15 years. However, there are some important and strict requirements that we really do need to advise our clients of now. It goes and the changes in the way that we are practicing. So as a property lawyer, the main immediate change to the industry is the change in disclosure requirements within a Section 32. The new legislation actually amends the Sale of Land Act by adding Section 32A CA, which applies for all land sold in Victoria, including residential land. So on the slide there, I've included the 3 items of disclosure that are required. So number 1, whether or not the land is CIPT tax reform scheme land. Number 2, the AVPCC code that Jamie was speaking about earlier, that was most recently allocated to the land. And thirdly, if the land is tax reform scheme land, what was its entry date? So what does that look like as a disclosure, and how do we get this information? So I've included a couple of examples of different types of properties that we have prepared Section 32s for lately. Looking at this first example, we know it is a sale of a residential unit. We've been able to obtain the code from the State Revenue Office land tax certificate, which now also includes a section for the CIPT. The certificate, you can see, states the code is number 124 and that the land is not a qualifying use. Some municipal councils are also including these codes on their council rate certificates. However, some of them aren't. So if you don't have access to certificates such as the land tax certificate, you may need to call the council in order to get this code. So as you can see down the bottom of the slide, code 124 is a residential company share unit within a multi-story development. And the screenshot on the left-hand side is the disclosure that we've made in the Section 32 on behalf of our client. So as per the legislation, firstly, the code is number 124. Secondly, the land is not tax reform scheme land. And just lastly, as the land is not tax reform scheme land, there is no entry date. The next example I've included is for a commercial property. So you can see on the land tax certificate that the code is 210, and it actually does state on the land tax certificate here in the commercial industrial property tax section that the code allocated to the land indicates a qualifying use, and that the land may enter the reform if an entry transaction occurs in respect of the land. The code 210 relates to a single occupancy retail premises. So our disclosure requirements here for our client is, firstly, the code is 210. Secondly, the land is not tax reform scheme land because it hasn't yet sold and therefore it hasn't entered the regime. And thirdly, there's no entry date. So let's look at a scenario based on the property information from that previous slide. Company A enters into a contract with Company B for the sale of the property. Contracts are signed in August 2024. Settlement occurs on the 20th of October 2024, and the land consequently enters the scheme. Company B owns the land for 5 years and then decides they want to sell the property in October 2029. There has been no change in the use of the property. What does Company B's disclosure requirements look like now? So going back to our Section 32, we know that the code allocated to the land indicates a qualifying use and that there has been now an entry transaction being the sale of the property in October 2024. So firstly, we disclose the code is number 210. Secondly, the land is tax reform scheme land because it was sold post 1 July 2024 and subsequently entered the regime. And thirdly, the entry date was the 20th of October 2024. So I'm going to talk you through a few more scenarios now to show a few different ways that the CIPT will have an impact. These are just a select few examples, and obviously you should be aware that there are a multitude of different ways that we might see the CIPT play out in the coming years. So firstly, building on the facts from the previous slide and the disclosure requirements we'd need to make when the property was sold post 1 July 2024. So Company B, who purchased that land in October 2024, decides they don't want the property any longer, and they've now entered into negotiations with Company C for the sale of the property. This settles in December 2029. It's been 4 years and 10 months since the entry date into the scheme, meaning the property still falls within that 10-year transition period. Assuming the property continues to have a qualifying commercial and industrial use, Company C will not pay stamp duty at settlement. And this is the windfall that Jamie spoke about earlier. Company C will also not pay CIPT for the remainder of that transaction period, and CIPT will commence in the calendar year after the expiry of the 10-year transition period, i.e. the 2035 calendar year. So therefore, Company C has the windfall of not paying stamp duty and not paying CIPT for approximately another 5 years. So your client, Company C, comes to you and as their advisor and says they've done the calculations, and despite the windfall they're going to receive of no duty and no CIPT for the first 5 years, they would prefer just to pay stamp duty and not enter this regime. What kind of advice would you be giving to them? Unfortunately for Company C, this is not an opt-in regime. Stamp duty has to be paid on the first entry transaction post 1 July 2024, and CIPT will commence in the calendar year after the 10-year transition period has expired. In the next scenario, we have a commercial property owned by John and Jack, who as tenants in common own 50% each. They've owned the property for over 30 years and it is currently leased to a retail tenant. The retail tenant has further options of 3 by 7 years available to them under the lease. The unimproved value of the land is $1.5 million. John and Jack unfortunately have a falling out, and Jack decides to sell his 50% share of the property to a genuine third party, James, who then pays stamp duty on the 50% share that he purchased. Settlement occurs on the 1st of February 2025. The sale of this 50% share will trigger entry into the regime, so it doesn't need to be 100% sale of a property. The transition period expires on the 1st of February 2035, and John and James, as 50% tenants in common, commence payments of the CIPT from the 2036 calendar year. So in 2037, John and James come to you as clients, and they provide you with instructions to prepare a renewal of lease for the long-term tenant they've got in the premises. You, as the advisor, request a breakdown of the current outgoings for inclusion in a disclosure statement as they are a retail tenant. John and James provide you with their CIPT assessment for the 2037 calendar year, which is $15,000, equal to 1% of the $1.5 million unimproved value of the land. They wish to recover the CIPT from the retail tenant. What will our advice be to John and James? So unfortunately for John and James, a landlord cannot pass on or recover the annual CIPT to a tenant. And it's much like the prohibition on passing on land tax to a tenant under the Retail Leases Act. John and James will be responsible for payment as owners of the property. In our last scenario here, we have Lucy, who is a property developer. Lucy enters into a contract for a commercial warehouse in Geelong. She has a vision of transforming the warehouse into loft-style apartments. As the property is located in Geelong and it's for a qualifying use, Lucy is still eligible for the 50% reduction in duty under the Regional Commercial, Industrial and Extractive Industries Property Concession, which has been in existence since the 1st of July 2019. The code relevant to this property is 320, which is a general purpose warehouse, and Lucy's purchase brings the property into the scheme. Lucy is eligible and she decides to take up a transition loan, as Jamie spoke about before, for the payment of the stamp duty, which is then registered as a first ranking charge on the title. Lucy then develops the warehouse within the 10-year transition period into her loft-style apartment, and consequently, it changes the use of the property to residential. Lucy comes to you for advice regarding the property. So I've got a few things to tell Lucy. Firstly, and most importantly, Lucy will need to notify the commissioner within 30 days of the change of use. Otherwise, there may be penalties involved. As Jamie earlier said, we're still waiting on some further guidance from the State Revenue Office regarding what they actually classify as the change of use and when that time would be. But we do expect it to be quite early on in the development. You can tell Lucy that the property will exit the CIPT regime because it's no longer commercial or industrial. However, the balance of her transition loan she took out to pay stamp duty will be repayable in full in order to enable this transfer to take place. Any future transfers of the land will no longer be subject to stamp duty, and CIPT will no longer apply. I would also in this situation be looking and advising Lucy of some other risks of other taxes. So for example, windfall gains tax, if a rezoning occurred here due to the change in use. So hopefully Lucy had the foresight to seek some advice prior to the development. As you can see, there's quite a few moving parts. So just to wrap up, there's a few key takeaways from the presentation today. Accountants, lawyers, conveyancing practitioners, and probably real estate agents as well really should read and understand this CIPT reform. Disclosure within a Section 32 is imperative. So non-disclosure in a Section 32 may actually be seen as a breach of the Section 32. And you could have a vendor client who might see a purchaser pull out of the contract because they haven't correctly disclosed the CIPT. As you've heard from Jamie and myself, this is a very long-term regime with long-term consequences. So it is important to give advice to your clients now. And lastly, if necessary, seek instructions to engage a specialist expert advice for the client if they're looking to transact on CIPT land or potential CIPT land. So that concludes the formal part of the presentation today. The recordings will be available in the next few days along with a copy of our slides. We do have a brief time for questions, see if we've got any. Rob's been busy answering a few questions on the side, so those people that who have asked questions, Rob has gotten back to them already, but if there is any more, please feel free to send through. And we will, send through the copies of the slides and our presentation in the next coming days. Thanks everyone for joining today.